Good day, and welcome to our webinar today, Financial Foresight, Essential Cashflow Forecasting for Business Leaders. I'm Ryan Chenier. I'm the owner and founder of Mastery Fractional CFO Services, and I'll be presenting today's webinar. All right. With respect to an agenda, I'm going to introduce myself and my company in just a moment. I'll do that properly. I'm going to talk to you a little bit about what a fractional CFO is all about. That's the service that we provide is fractional CFO services, and cash flow forecasting is an aspect of that. I'm going to talk a little bit about financial KPIs or key performance indicators. Cash in the bank is one of those key performance indicators on the financial side, and we're going to talk a little bit about that. And then we're going to get into depth about cash flow forecasting, what that's all about, what it means, how you can use it to help avoid risks in your business, and help you drive better financial results overall and make better business decisions overall. Okay, so to begin, my company is Mastery Fractional CFO Services. I started this company in 2019. We service our clients in a variety of places in Canada on a 100% online and paperless basis. This is for optimal efficiency. We can screen share using cloud-based accounting platforms. We can work with our clients on their data from our offices where my team and I have our proper screens and our proper set up, well positioned to help our clients. Our clients can work with us from anywhere as long as they have an internet connection. And we find it works very, very well, and it's very, very effective. I am the CEO of the company. I'm a fractional FCO or CFO rather, Chief Financial Officer. I'm an entrepreneur. I've got a Master's of Business Administration degree and decades of experience working with a variety of different companies, from multi-million-dollar companies that are international with operations in Canada to individual people who have needs and requirements on the financial side. And I really enjoy helping people out. I really enjoy business, and I find that this stuff energizes me, and that's why I do it. Okay, here's the question that I propose to anyone who's here today. Have you ever struggled with cash flow in your business? Many companies do. It's not unusual, and I can feel your pain if you are nodding or saying yes to this question. Another way to ask the same question is to break it down a little bit. Have you ever felt lost when trying to predict your business's cash needs? Have you ever been short of cash when you needed to pay bills or employees, even though your business is profitable? Have you found it hard to match your bank balances with your sales forecasts? Or have you had trouble figuring out if you can invest in new equipment or staff? Have you missed a chance to grow your business because you were unsure about your finances? These questions, if you've answered yes to any of these questions, it indicates that you've had challenges with cash flow. Again, not unusual in a growing business, even if it's profitable. Okay, well, let me set the frame a little bit for this. What is a fractional CFO? To explain that, I'm going to talk about the framework of every business. Every business has three main functions or units: sales and marketing, operations, and accounting and finance. And these different business units are overlooking all aspects of the business in collaboration and coordination with one another. And the better that collaboration and coordination and alignment is, the more efficient and effective the business runs, and ultimately, the more successful it's going to be. Now, many small businesses struggle or fail because of a lack of attention or understanding of the finance part. Sales and marketing is bringing in the leads and capturing leads and making them clients or customers. Operations is delivering upon or fulfilling upon what was sold to the clients or customers. But finance is managing the accounting side of things, the planning and analysis side from a numbers point of view. And small businesses don't often have somebody who's looking after that with expertise and proficiency. They may have capabilities in place, but not enough to optimize the functioning of the entire business. Each one of these business units, think of it like a leg on a stool. You've got three different legs on the stool, and if one of those legs isn't that strong or is about to collapse, the entire stool is unstable. And so it's important to have proper financial expertise in your organization. So a growing, scaling company needs a bookkeeper. Most companies understand that and have a bookkeeper, someone who records the company's financial transactions and does the record keeping. They need a tax accountant to be compliant with government regulations. You need to file your income taxes. The tax accountant focuses on just that, filing the income taxes and ensuring that the business is compliant with government regulations. But really, most tax accountants don't get too much more involved in your business. And they may meet with you at the end of the year, maybe once during the year to do some tax planning. But a fractional CFO, or Chief Financial Officer, CFO stands for Chief Financial Officer, assists the leaders of the business with the development of financial strategies that drive sustainable growth. And the fractional CFO, understand, it's like a regular CFO or Chief Financial Officer in a large company. A Chief Financial Officer is a key executive in the company that reports generally to the president or to the CEO and collaborates with the other business leaders like the vice president of sales and marketing or the chief operations officer or what have you. But that person is a very integral part of the business that works on the financial side. So the accounting and finance department is the responsibility of that executive. And that executive is providing information to the other business leaders, especially the CEO, helping manage the finances and accounting to the optimization of the business as a whole, making sure that the financial and accounting components of the business are in alignment with the sales and marketing department and with the operations side of things, so that the business is operating in a synergistic way, and so that the financial component of the company's overarching goals is being managed properly and is in place, because the financial side of the business funds the rest of the business. The money to operate the entire company ultimately is going to be funneled through or filtered through the accounting and finance department. And so managing that to the optimization of the company is very important. That's a CFO or a Chief Financial Officer for a large company. That's a full-time, on-staff, high-paying executive position, and that's not within the budget of most small to mid-sized companies. Well, this is where a fractional CFO can come in. A fractional CFO does the exact same things that a full-time CFO would do, but on a part-time basis. And a fractional CFO is a third-party, independent, not an employee. It's a contractor, but that fractional CFO can work with the company and its business leaders on a regular, ongoing basis, but just on a part-time basis. Okay, so it's affordable, but it provides and puts in place the tools and expertise and management required to do the proper planning from a financial point of view, the budgeting, the forecasting, and ensuring that all resources in the company are allocated efficiently in a way that maximizes the profit and minimizes the financial risks. This fractional CFO, many companies don't have a fractional CFO, but they need one. And so this is what my company does, and there's other companies that do it as well. But it's something to consider. And one of the things that a fractional CFO does, well, here's a few things. Number one, leverage the time of the business owners. Okay, so here, what problems does this fractional CFO help solve? In a nutshell, we help our clients leverage their time with executive level financial leadership. The leader of the business, whether it be the CEO or president or owner or what have you, doesn't have time to focus on sales and marketing and operations and finance all at the same time. That leader's focus is going to shift around to the different functional areas of the business. But when they're not focused on finance, they need somebody who can focus on that finance for them and make sure it's being managed properly. And when they need to dial into finance, they want somebody who can explain in clear language what's going on the financial side and what to do about it. And in some cases, they need to have a person who can explain, hey, if we make this decision, what's the impact on the financials going to be? And if we make that other decision instead, what's the alternate impact on the financial statements going to be? That helps leverage the time of the business owner. Also, we help our clients reduce stress. It's great to be able to know that your financial and accounting portion of your business is being looked after. Often clients will come to us years behind on their bookkeeping and their taxes, frankly. We can help them get that set up. And fractional CFOs can do that and so much more. Generally, we're focused on financial planning and advisory or analysis work, financial planning and analysis work, looking forward, but the advisory part and making sure things are in order from a systems or IT, information technology point of view, and a processes point of view on the accounting side is another part of it. So a fractional CFO can help oversee the bookkeeping, and the bookkeeper can help make sure that the proper accounting platforms are in place and that they are efficient and that they are effective and that they are audit proof and that they are readily available to make good business decisions. They help increase cash flow, they help profit, and they help company scalability. Okay, because if you're growing, you need to align your finances to support that growth. And that's part of what a fractional CFO can help do. But overall, we're talking about helping a business owner, leader, manager achieve clarity with respect to their business finances. And understand, as a business leader, you've got to be looking at your numbers. It's a key aspect of what you need to do. If you're not doing that, there's a huge opportunity for improvement in your business. Okay, financial key performance indicators. Let's talk about those for a little bit. I'm not going to dive into the weeds on this, but this is a dashboard of financial key performance indicators. And what you've got here across the top are 13 months. In this example, it's July 2022 to July 2023. We're tracking 6 key performance indicators here on the financial side. Revenue is one. So revenue would be sales for the company. And you can see the sales throughout 13 months. The variance is the variance between this month of July and this month of June. You can see it's a negative value. You can look at gross profit across the board. We've got net profit and cash. Okay, so you've got the actual numbers there, and we've got the visual representations in graphs here. Revenue by month, gross profit by month, net profit by month, and cash by month. Now, part of what a fractional CFO can do, if you're wanting some detail and clarity with respect to what this really means, fractional CFO can help you understand and interpret this. But we're not going to focus on all of these. There's also gross profit margin and net profit margin. But I am going to focus on cash by month in today's webinar. Okay, cash by month, that's the amount of cash that you've got in the bank at any given time. That's a key performance indicator. And that has to be managed. And one of the ways we manage that is with a cash flow forecast. So let's talk about that. Cash flow planning and forecasting. Cash flow. Cash flow concerns can be stressful. Will we be able to make payroll? Critically important. If you've invoiced a number of clients, you've done work, you've invoiced them, you're expecting the money, you know it's coming, but payroll's due today and that money's not in yet, that can be stressful. Cash flow can be hard to predict. It's not clear exactly when money's going to be landing in the bank versus when money has to go out. It might be for the next couple of days, or it might be easier to estimate, but it's harder to estimate 1 month out, 2 months out, 6 months out, 12 months out. And yet some of the decisions you make today are going to impact or be impacted by your cash in the bank months away from that. Cash flow problems, as a matter of fact, are one of the main reasons why businesses fail. So you think about that. Typically, it's growing profitable businesses that run into cash flow problems. And that's one of the main things that derails them. So you want to manage that. So why create a cash flow forecast? Well, to manage that, to identify potential shortfalls due to cash flow bottlenecks, and to take corrective action in advance. We'll show you how you can do that in a moment. You need to understand the impact of different decisions in advance, and a cash flow forecast will outline that for you. You need to recognize opportunities such as cash flow surpluses in advance, because if you understand when you might have a surplus, you can more earlier in the process than you might otherwise do, plan to grow, plan to invest in ways that will help you grow profitably. And last but not least, a proper cash flow forecast is considered a best practice for business finance management, and it can provide assurance to investors and lenders that the business is being properly managed and has appropriate financial control. If you've got investors and lenders, or if you're at some point going to have them, you want to have cash flow forecasting in place as a tool that's being utilized on a regular basis. Well, there are different kinds of cash flows. Cash inflows are cash that's received into the bank. So from cash sales, for example, cash received from accounts receivable, sale of fixed assets, interest on bank balances, grants you might receive, loans you might receive, money contributed by owners or shareholders. And then there's cash outflows. These are payments to suppliers, wages and salaries, payroll, payments for fixed assets, taxes that you have to pay because you owe them, interest or repayment of loans and credit cards, dividends paid to shareholders. Those are examples of cash outflows. And with cash flow planning, you want to consider, generally, you want to ask yourself questions like, okay, what new things are we looking at doing? When should we do them? When do we want to do them? How much will they cost? Will cash inflows result? What will the cash outflows be? What will that mean to our overall cash position? Should we rethink any of these things or the timing of any of these things? That's all part of the cash flow planning process. Once you've got that in place, you create your cash flow forecast. You start thinking about how you're going to answer these questions, the tool you're going to use to do that. And there's a variety of different ways you can set up a cash flow forecast. This is an example of a monthly cash flow forecast. What we've got is November 2023 in this example, all the way out to October 2024. So this is from a previous period, but generally you're doing this in advance. So you'd start this, we're in February, call it March 2024 is when you'd start this if you're creating one from scratch. Okay, but in this case, it's from the past, and that's okay. Cash received from sales. This was all forecasted at the time, $150,000. This is a cash inflow that's expected to be received, and we've got this across the top. In this example, we're keeping things relatively simple, but the cash received from sales is $150,000 expected, and that's the case for every month of the year. So you can see the total cash into the business is $150,000. Then we've got cash out. And in the cash out column, we've got cost of goods sold. So this could be materials or subcontractors or permits. There's a wide variety of different things that could be entailed here. Office supplies, payroll, auto. You can see all of the different line items. But we've also got down near the bottom half of this, not just what you'd see on your profit and loss statement, but also things from your balance sheet. So would we be paying down our credit card? Will we be paying our PST or our GST? Are we going to be paying loans or anything like that? Are we going to make some asset purchases? You include those on your cash flow forecast as well. Again, this is a simple example. You can get more complex, but you can suffice it to see how this is very representative. And this is some actual data from an older cash flow forecast. But you can see how it's quite representative of what a company might experience in terms of money in and money out of a business. Okay, so the way it's planned is at the beginning of November 2023, this company had $1,000 in the bank. They're expecting $150,000 in. All of this cash out was added up, and they were expecting $127,000 in change out, which meant that their monthly change in cash was going to be positive $22,250. So cash at the end of the month is the change in cash plus the original amount in the bank. They were expecting by the end of November, they'd have $23,250 in the bank. That number here at the bottom carries over to the top. And in December, the expectation is there's going to be $23,000 in change in the bank. All right. They were expecting $150,000 in sales in December. They were expecting all of these expenses. And at the end of December, the total cash out was $129,000. The monthly change in cash was $20,000, almost $21,000. So they're expecting about $44,000 in the bank. You can see this business is not a bad business. It's not a large business. It's not small either, but it's profitable. All right. In January, they were expecting $44,000. That carries over from the end of December. They're expecting to have $44,000 in the bank. Here we are. It's January 2024. This company paid back their CBIL loan. And what that meant is that although they had $150,000 coming into the business, they had their GST payable, their PST payable, the CBIL loan payable. They were expecting $191,000 out of the business. The monthly change in cash was negative $41,000. So the cash at the end of the month was only $3,000. Well, that's okay. There's money in the bank. No reason to panic. But here's where the planning tool came in very useful. So what happened was they were planning on buying a van and trailer for purposes of doing what they did. It was on-site installs. And that purchase was going to be about $40,000. Their plan was to do it in February. That's what they were going to do. There was no question about it. We plugged it into the cash flow forecast, and this is what the situation was in January or in February. February. At the end of January, $3,000 in the bank. Beginning of February, $3,000 in the bank. Cash received from sales, $150,000. Cash out of the business, fairly usual from an expense point of view on the P&L. But when it got down to the fact that they still had to pay more PST in February, and they had that $40,000 asset purchase planned, they realized that there was going to be a negative change in the cash balance again, and they'd be out of money. This wasn't going to be a good decision. It wasn't something that they were going to be able to commit to doing, and so they needed to make some changes there. This was going to be a problem for them. It was going to be a small pitfall. And again, simple example here, but it goes to show how a cash flow forecast can outline how some of these things, some of these decisions you might make, it's very valuable in advance to be able to see the impact on the cash. So let's fast forward to this is the before picture, okay? Let's fast forward to the after picture. After doing this analysis with them, when we did it, we went back and we said, okay, well, you can't purchase the van and trailer there. That's clear. Let's put that off into March and let's see how that impacts the cash. So if you recall, at the end of January, they were at a position of having $3,000 in the bank. At the beginning of February, they're expecting $3,000. Their sales were $150,000. They're expecting $150,000 in sales. They had their ordinary expenses. They had their PST payable, but because they put off that purchase, or they planned to put off that purchase of the van and trailer, their cash position was in a positive situation, which meant they're going to have money at the beginning of the bank, money in the bank at the end of the period. And for March, that meant that they were beginning the month with nearly $24,000 in the bank. If you follow through the exact same calculations, including the assets purchased in March, although that meant that there was a negative change in cash balance for the month of March, overall, that meant that they'd still have a positive bank balance. Now, again, this is a very simple example, and it's primarily, the primary focus here is to just outline how cash flow planning can be used. As your business grows and scales, it can get more complex and more serious than this. If you plan, for example, on moving to a new facility and your rent might go up a lot, and at the same time you want to hire an executive assistant and maybe some more field staff, those kinds of things can impact your financial statements substantially. And if you're expecting your sales to increase, but if they don't, you have to allow for some potential risk in the equation. And you can look at these things from different points of view when you're doing your cash flow forecasting. But by virtue of being able to put the numbers on the spreadsheet and see what the impact of different decisions might be on your finances, you can make much better business decisions, and you can make those decisions with mental clarity. And when you make those decisions, you can understand possible alternatives just by looking at the numbers that, alternatives that you might not see if you didn't have this in front of you. Don't get me wrong. This isn't calculus. This isn't advanced math. It's just addition and subtraction, but there's lots of it. And when it adds up like that, it compounds to a degree that you can't necessarily anticipate it with your gut feeling. And most businesses that are growing from, being small to mid-sized, going 1 million, 10 million, 15, 20, 25 million, cash flow forecasting becomes more challenging, and the compounding of all of these numbers gets far more difficult to predict. But when you put it down on paper like this, you can build in your tolerance for risk. You can look at different scenarios, most likely scenario, worst case scenario, best case scenario. You can do it weekly instead of monthly if you want. You can do it for 24 months if you want, or you can just start with 3 months at a time. There's all sorts of things you can do, but it's a valuable tool. And as I mentioned, it's a fundamental component of what a business wants to do as it's growing and developing. Okay, so let's do a little bit of review. Cash flow forecasting provides clarity, provides confidence. You can operate with confidence, knowing you've looked at this and you understand what the potential pitfalls might be and where the opportunities may be. It gives you some peace of mind. You can sleep at night. You don't have to. Have you ever worried about payroll? It's not fun, but you don't have to when you plan around a cash flow forecast. It answers the question: can I afford to hire for that new position? Can I afford that new piece of equipment? Can I afford to go to that conference, or pay myself more, or all of the above? And when can I afford it? It's the timing of it that's important as well. Cash flow forecasting gives you clarity regarding what you should spend your money on, when you should spend it, why. Is it a necessary expense or a good investment? It helps you get clarity with respect to what the impact of these decisions will be in your bank in the short, mid, and long term. It provides you with a better understanding of how your decisions will impact your finances. It enables you to be more intentional about changing future results in a positive way. And that's a big part of it. When you understand what your cash flow position is going to be, it helps you plan for those other key performance indicators we just briefly glanced at, and other key performance indicators that your company might want to track that are relevant to your business. If you understand your cash flow forecast, you might be able to make an investment, say in advertising, that's going to increase your top line sales numbers. then now you're being intentional about increasing your revenue. You might decide that you need to cut some expenses. Now, you can't cut your way to ultimate success. Just cutting expenses, I mean, there's a limit to how much that's going to do. But in some cases, it's the right thing to do, and you can understand that better. And when it's not the right thing to do, you can understand that better too and look at the alternatives. Cash flow forecasting helps you be bold. You can take action with confidence because you know what's going on. You can learn, from your cash flow forecasting. You'll learn about things in your business that you might not have been learning before because you're paying attention to the numbers in a way that you may not have been paying attention before. It can help you make adjustments in advance, proactively. It's a bit of a crystal ball into the future. It's not 100%, but it's directionally accurate, right? And you get more and more accurate as you go through the process and you work on it. And it allows you to take more action. You don't have to sit and wait so much. You can understand where the opportunities are and take advantage of them. Helps you move forward with confidence. Cash flow goals. Well, with cash flow forecasting, you can assess the financial statements that need to be true to achieve your goals and then work backwards. So with cash flow forecasting, you can say, all right, we know what the cash flow forecast is going to look like. So we can build out our revenue. We can understand, hey, we think we're going to be here in terms of our cash. We've already done that on the cash flow forecast, more or less. Cash coming in from sales isn't exactly the same as invoicing sales in accrual-based accounting. I'm getting into some technical terms here, but suffice it to say you can predict what your sales might be, your cash might be. You can also start to play around a little bit with what your profit might be by looking at, hey, we've got extra money here. Let's invest that and change our sales in Q3 of this year. Let's do some advertising. And the examples, there's so many of them. You can invest in capacity. Should we move to a new facility to enable us to hire more people, to enable us to grow? There's all sorts of things you can do when you're looking at this. But the idea is, you put together, you say, these are our goals as a company. Let's put together what the profit and loss statement and the balance sheet needs to look like in order for us to know that we've hit our goals. And then you can try to make that happen. You can try to say, we need more sales. So let's now try to figure out when to spend our cash and in what ways to make sure we have more sales. Or if you need more profit, you can look at what are some of the different things we can do to drive bottom line profit results. And there's a whole wide array of things that drive net profit that have an impact on that key performance indicator on the financial side. That discussion is part of what fractional CFOs can get into with a company and figure out, ultimately, the bottom line here is you figure out what needs to be done, by whom, and then create an action plan. You take that plan, that overall plan to create the financial statements you want at the end of the period. You break it down into actionable steps, and then you assign each one of those steps as a task to task owners with timelines, and you manage that. You follow through with accountability checks and you make course corrections along the way, but you manage that and make things happen in your business. I don't know who originally said this, but I love it. I always say there's three kinds of people in this world: people who watch things happen, people who make things happen, and people who go, what happened? You want to be one of the people who make things happen, right? Cash flow forecasting helps you do that. Okay, cash flow forecasting pro tip. Well, start small at first. Absolutely don't overcomplicate it. Just start very small, maybe a couple months at once. Keep the line items relatively simple and understandable, but develop the discipline to use the tool as a part of the process for making significant decisions. It should be a tool that's in place for your accounting and finance department. However small that is, that tool should be there. If you're a solopreneur with no staff, this just isn't likely to be an issue. But as you grow and you add staff and you get to be $500,000, $1 million, maybe more, around that point, it becomes very important. And if you're larger than that, it's fundamental. For most businesses, not all, I'm talking in general terms here. More pro tips. Be a little conservative, but don't worry about being super accurate. Be conservative when you're saying, hey, we're expecting $150,000 of cash to come in. If you think it might be 140, put down 135. It helps you be safe. But you don't want to be overly safe. You want to look at different scenarios. What's the worst case scenario? What's the best case scenario? What's the most likely scenario? And understand the worst case scenario isn't $0 typically. I mean, you might have a little bit less than you would have thought, but you don't want to be so conservative that the tool becomes useless. You want to think in terms of likelihoods, and you can make adjustments along the way. But consider different scenarios and be conservative, but understand you will get better at this, and it still helps. Even if you're only 80% accurate, it's still going to help you versus not knowing. So here's my challenge to you. Try it out. If you don't already do this in your business, try it out. If you already do this, I'm not sure if by virtue of talking about it, I may have unlocked a few thoughts for you that might help you do even better or might help you get more out of it. But if you haven't already, absolutely try it out. If you do keep a cash flow forecast, think about some of the things I covered today and how you can use them to improve your forecast and the impact it makes on your business. And if you want Mastery Fractional CFO Services to work on this with you, book a Zoom meeting with us for a free initial consultation to discuss the next steps. I'll be happy to discuss things with you. If we think there might be a fit between our two businesses, great. We can talk about what the next steps might be. And if not, that's okay too. I'm going to try to leave you with some things to think about that could potentially help you. I enjoy meeting with other business owners, even if it's an initial consultation where we don't end up doing business. I always find I leave those conversations a little bit smarter, and it's always great to meet people. And I hope to be able to impart something of value to you as well. With respect to questions and answers, I'm not going to be answering any questions today, but feel free to reach out to me. If you have detailed questions, book a consultation. We'll have a discussion. I would welcome the opportunity to touch base with you. Wish you very well with your business and with your cash flow forecasting. That's it for today. Thank you.